Everyone's been whispering it. Are UK house prices about to crash? The numbers tell one story, but the mood on the ground tells another. After months of cautious optimism, the housing market has entered a strange pause. Buyers are waiting, sellers are hesitating, and everyone's watching the autumn budget like it's a cliffhanger. According to Halifax, the average UK home now costs $298,184, down 0.3% in September. It's not a collapse, but it's a clear signal that the market's momentum is fading. Growth has slowed to just 1.3% year-on-year, the weakest since early 2024. Experts say the slowdown isn't about affordability anymore. It's about fear. Fear of what the government might do next. In the past, housing market dips followed predictable patterns: high interest rates, recession, or mass unemployment. But this time, the culprit seems to be uncertainty itself. Speculation about new property taxes and changes to stamp duty have left buyers frozen. The result? A market that isn't falling, but isn't breathing either. And that's the danger. Because when a market stops moving, confidence evaporates fast. As one analyst put it, it's not a crash yet, but it feels like we're standing still at the edge of one. Across the UK, homes are sitting unsold. Viewings are quiet. Estate agents' report calls have slowed. According to Knight Frank, high supply and high uncertainty are pressing down on demand. The anticipation of the autumn budget has done what even mortgage hikes couldn't. It's stopped people in their tracks. Some homeowners fear a new property tax on sales over $500,000 could replace stamp duty altogether. Others are holding off, hoping clarity will arrive before Christmas. Zoopla's latest report paints a sharp picture. Demand for homes over $500,000 has dropped 11%, while new listings are down 9%. The slowdown isn't just in London. It's spreading into southern England, where affordability pressures are biting hardest. For many, the fear isn't losing money, it's making the wrong move. Buyers wonder if waiting could save them thousands. Sellers fear the opposite. The stalemate has created what analysts call a psychological freeze, and it's not just numbers, it's sentiment. Property chat rooms and Reddit threads are filled with hesitation. Should I buy now or wait? Is this 2008 all over again? The mood is cautious, almost eerily calm. But in markets like this, calm doesn't always mean safe. For months, rumors have rippled through Westminster and across the property sector. The government may replace stamp duty with a new annual property tax on homes valued over $500,000. It's only speculation, but speculation is powerful. And it's already changing behavior. The idea of a yearly tax rather than a one-time payment has left homeowners in high-value areas deeply uneasy. London's upper market, already under pressure, is showing the earliest signs of retreat. Zoopla's data shows a sharp fall in new listings, an 11% drop in demand, and a 9% reduction in homes hitting the market. Many buyers have paused, unwilling to commit until the autumn budget reveals the government's true intentions. People aren't just worried about what houses cost, said one London-based analyst. They're worried about what they'll owe next year. The rumor mill has also targeted landlords and investors. Some fear that rental income could soon be subject to national insurance, a move that could deter small landlords and squeeze supply further. Others suspect that capital gains exemptions on primary homes could be reevaluated for properties worth over $1.5 million. These are still just whispers, but whispers can echo. The high end of the market is freezing, and that's rippling down the ladder. If wealthy homeowners stop buying or selling, chain reactions spread. Fewer transactions, less movement, and more price stagnation. What began as a rumor is now reshaping decisions. And while the Treasury has stayed silent, the fear alone has been enough to cool the heat from one of the UK's most resilient sectors. But as one analyst warned, markets don't wait for policy, they react to whispers. Even before the budget talk began, cracks were forming. Some of Britain's most iconic postcodes have quietly seen prices tumble. In Camden, Borough, and Abbey Road, house prices have fallen by nearly 50% since 2019. According to This Is Money, what were once booming zones for international buyers are now cold spots in a cooling market. Analysts link the slide to a triple hit: interest rate hikes, new tax rules for non-doms and second homeowners, and broader affordability strain. The government's clampdown on overseas investors and luxury landlords, while politically popular, has stripped liquidity from the upper end of the market. And when the top tier slows, mid-range markets soon follow. Across the southeast, price drops are spreading like hairline fractures. Homes that once sparked bidding wars now sit idle, waiting for offers that never come. Estate agents describe open houses that used to be packed now eerily quiet. Meanwhile, the psychological shift is deepening. For years, property was seen as an untouchable investment, an asset that only ever went up. But the headlines have changed. Today, it's about decline, uncertainty, and risk. The data supports the sentiment. The Office for National Statistics recorded growth at just 3% in August, slipping from 3.2% in July. Rightmove reports that asking prices rose a mere 0.3% last month, the weakest October figure in years. In isolation, these figures look small, but combined with the fear of looming tax reforms, they signal something deeper, a loss of confidence. And confidence is the foundation of every housing market. Once that cracks, everything else starts to shift. Economists call it a slow-motion car crash. It doesn't happen all at once. There's no dramatic collapse, no sudden panic, just a quiet slide that gathers speed in the background. According to Money Week, Britain may already be halfway down that slope. The warning signs are clear: stagnating prices, rising supply, and households under growing debt pressure. Millions of fixed-rate mortgage deals locked in during the ultra-low interest era are expiring. As they do, monthly payments jump by hundreds, sometimes thousands by cans of pounds. Second homeowners faced with new levies and higher costs are selling up. Their exit floods the market with stock just as demand dries up. The result is a dangerous imbalance. Too many homes, not enough confident buyers. The Telegraph warned that Britain's homeowners are heading toward a cliff edge. The phrase might sound dramatic, but behind it lies hard arithmetic. Household budgets are squeezed. Wage growth hasn't kept pace with inflation. And even though interest rates have stabilized, borrowing remains far more expensive than during the property boom of the 2010s. The effect? The market moves slowly, painfully so. Properties take longer to sell. Buyers hesitate to offer. Each month, a few more sellers reduce their asking prices, hoping to catch dwindling demand. Experts agree this isn't a 2008-style crash. But in some ways, that makes it worse. Crashes end. Stagnation lingers. And with the economy still flatlining, the slow-motion narrative may continue long into next year unless confidence somehow returns. But as one analyst put it, you don't need panic to have a crisis. Sometimes hesitation is enough. For the first time in years, it's being called a buyer's market. Homes are staying on the market longer, and price reductions are quietly increasing. Rightmove reports sellers are trimming expectations, some by 5–10% just to secure viewings. On paper, that should be good news for first-time buyers, but experts warn it might be a trap. The reason is timing. When markets turn uncertain, even small drops can mask bigger movements ahead. People think they're getting a bargain, says a Knight Frank analyst, but if prices fall again after the budget, those bargains could evaporate. At the same time, affordability remains stretched. Mortgage rates have steadied but remain high compared with pre-2022 levels. Monthly repayments are still eating a larger share of household income, meaning cheap homes aren't necessarily affordable ones. Zoopla's latest survey shows buyer demand inching up in lower-priced regions, while the south of England continues to cool. That divide could deepen. Buyers in the Midlands and North are starting to act, sensing opportunity, while wealthier southern markets stay frozen. Sellers, meanwhile, face difficult choices. Many are lowering asking prices reluctantly. Others are pulling listings entirely, waiting for clarity after November's budget. Estate agents say it's creating a patchwork market, busy in some pockets, deserted in others. Analysts agree that for serious buyers, waiting for certainty might backfire. Transactions already take 6 to 7 months, meaning any deal started now will complete well into 2026. In short, hesitation could mean missing the recovery as or catching the downturn at its worst. And that's the dilemma defining 2025. Act now and risk overpaying, or wait and risk being left behind. Forecasts are supposed to reassure, but right now, they tell a confusing story. Major firms like Savills, Halifax, and Zoopla all predict modest growth for 2026, somewhere between 1% and 4%. Yet those projections come with asterisks, disclaimers, and cautious tones rarely heard during boom years. Savills, for instance, recently downgraded its 2025 forecast from 4% to 1%, citing prolonged budget uncertainty and weak buyer sentiment. Halifax expects small gains but warns that any new taxation could reverse progress overnight. Behind the scenes, confidence is fragile. Mortgage approvals remain below long-term averages, and transaction volumes are down almost 20% from pre-pandemic levels. Lenders are slightly loosening affordability checks, but that has yet to translate into real movement. Analysts describe the outlook as a fragile equilibrium. Not a crash, not a recovery, but a holding pattern. For homeowners, that means equity growth could stall for years. For would-be buyers, it means patience might finally pay off, if they can ride out the uncertainty. The danger is that these soft landing forecasts create complacency. Governments may see them as permission to tighten policy further, while investors may assume the worst is over. But the fundamentals, sluggish economy, heavy debt, and weak confidence, haven't changed. As one property economist put it, hope isn't a strategy. Until we know what happens in the budget, everything else is guesswork. So the optimism you see in headlines might just be the calm before the next correction. A pause before reality catches up. Beyond the immediate turbulence, the long-term picture could still brighten. Analysts expect wage growth to rise about 22% between 2025 and 2029, giving households more spending power. If inflation continues to cool and interest rates drift lower, confidence could slowly return. Savills projects stronger growth from 2026 onward. 4% in 2026, 6% in both 2027 and 2028, and 5.5% in 2029. Those numbers reflect optimism that the economy will strengthen and lenders will keep easing borrowing limits. Indeed, the Bank of England recently signaled it may allow more high-income loans, raising the cap from 4.5 to over 5 times salary. Nationwide estimates this could boost the average buyer's borrowing capacity by roughly $28,000 for first-time buyers shut out in recent years. That's meaningful, but the path back to stability isn't guaranteed. If new taxes land harder than expected, or if global markets wobble, those positive forecasts could evaporate quickly. Property cycles often depend less on economics than emotion, confidence, fear, and herd behavior. That's why experts caution against reading too much into the next quarter's data. Recovery, one analyst notes, doesn't come with a press release. It sneaks up slowly. For now, the market remains on edge, hopeful, cautious, and painfully aware that the next headline could swing sentiment overnight. So are UK house prices about to crash? The answer depends on how you define a crash. There's no mass panic, no queues outside banks, no plunging valuations. But beneath the surface, the warning signs are undeniable. Prices are softening, confidence is fragile, and political uncertainty is freezing decision-making across the board. The coming months will hinge on the autumn budget. Its decisions on property tax, landlord levies, and capital gains could either steady the ship or push it closer to the edge. For now, the market walks a narrow line between correction and collapse. Economists remind us that housing crashes don't start with panic. They start with silence, with hesitation, with people waiting, watching, and doing nothing. And that's exactly where the UK finds itself today. As one commentator put it, we're not in free fall, we're standing on thin ice listening to the cracks. So keep watching. Because whether this turns out to be a soft landing or the start of something larger, one thing is certain. The story of the UK housing market in 2025 is far from over, and if you want to stay ahead of what happens next, plug in your headphones. Hit subscribe and keep your eyes on the numbers.